Welcome to Trailblazing, capitalizing on tax receivable agreements, a Parallaxes Capital podcast that is here to guide you through the world of tax receivable agreements. It's time for Trailblazing.
Hey everyone, now that we've completed 10 episodes with some of our favorite guests, we wanted to compile their responses as to some of the questions that we have as to how they found themselves and their love for the law, as well specifically tax law, but also how they first learned about TRAs. Enjoy. Tell us about yourself and how you found yourself into the wonderful world of tax.
My story really begins actually before I got into investment banking. So I started my career actually as an attorney. I went to law school and then worked for a large law firm here in New York City, big corporate law firm, did a lot of M&A work and capital markets work. And I basically got a call out of the blue one day from a recruiter and I was a tax lawyer at the time, that invited me to apply for a job opening at an investment bank to work on what I do now, which is structuring and transaction advisory. It was a call I was not expecting. It came out of the blue. I didn't actually even really know that much about the job, but as I learned more about it, I became more enamored with the idea. Some of the things that I would be doing I thought would be a really great fit for my own personal interests and professional interests. And so I made the career change and went into investment banking. That was about 12 years ago or so, and have been working on the financial side of the advisory business ever since.
How did I get into tax law? My father was a tax accountant. His father was a tax accountant. And my sister is also a tax accountant. So maybe you could say it was in the DNA. But my particular path was a little more practical. I showed up at the University of Texas in Austin and was asked to pick a course of study. And so I asked the question, what is the major that is most likely to lead to gainful employment? And the answer is engineering. And then when I looked at the syllabus and saw calculus for engineers, I thought, okay, what's the second most likely path for business school? So I enrolled in the business school and then chose accounting, and then within accounting chose tax. I gave some real consideration to starting in public accounting, but I also always had wanted to go to law school for some reason or another, and not necessarily to be a tax lawyer. It just it was something I was always interested in, and I had decided that if I started earning money sufficient to have a decent meal, I might not go back to being a poor student again. So I should just power right through. So I went on to law school and actually had a hard time debating between tax and corporate. I spent some time in both of those areas. But once I got immersed in some of the tax projects, I knew that was the right home for me. It sort of fit my personality well. So maybe it is in the DNA.
Well, it actually started because I thought it would be a good way to effectuate social policy. It's something that Congress does from time to time, incentivizes behavior through the tax code. And I just thought that would be an interesting way to blend my interest in social issues with my interest in finance. So that led me into tax. And then in law school, I went to the University of Chicago for law school, and there was a really fabulous tax professor named Wally Blum, who was a real titan of the field in his generation, helped craft the modern income tax. And I heard he was a great teacher, so I took the class and just sort of kept going from there.
In terms of why I'm a tax lawyer, that's kind of an interesting story. When I went to law school, like everyone, I thought I was going to be a litigator because that's, you watch it on TV and that's what lawyers do, right? I didn't really understand the world of transactional. I spent a summer, I worked at Martel and I loved it. And transactional was super interesting. And I thought I was going to be a transactional lawyer. And then the summer after my third year of law school, I worked at a law firm again, happened to be Kirkland, although I didn't start out here, but I ended up back up at Kirkland. And during that summer, I went to this presentation. They had each one of the groups come and explain, this is what it's like to be a corporate lawyer. This is what it's like to be a funds lawyer. And then there was one that this is what it's like to be a tax lawyer. And I had taken I didn't take really any tax classes until my third year of law school, and I really liked them, but it was, I'd never thought about being a tax lawyer. And the guy who gave the "This is what it's like to be a tax lawyer" speech is Todd Maines, who is still at Kirkland, who, I owe my career to him. He got up there and he didn't talk about tax law. I always tell this story. He talked about one of his children, and he seemed like such a nice guy. And so I went up to him after and I asked him for a project. And I worked with Todd and the members of the tax group for the rest of the summer and just really loved it. So that's why I'm a tax lawyer, is because of Todd Maines. So
wonderful world it is. Like many, Andy, I didn't grow up thinking that I was going to be a tax attorney or go to a big four firm and lead a vertical within M&A. When I was growing up, I thought I'm going to be a Major League Baseball player. Let's say for like the Chicago Cubs or some other silly non-attainable goal, right? And then over time, I realized I wasn't going to be the third base for the Cubs, and moved into law school. That's where I really had a passion for tax, and did that after a brief failure in the real estate industry.
It's been a journey, I'd say. Holistically, I started here, obviously working at Deloitte a number of years back. Chicago born and raised, Cubs fan. I went to the University of Illinois, Urbana-Champaign, which is a university you may or may not know about. I know, Andy, you do from your interactions there. I, right? But yeah, effectively started at M&A, started doing tax work, transaction work, deal work, and then had the opportunity to really kind of evolve my career more in the direction of partnerships, LLCs, LPs. From my perspective, it's extremely challenging world of tax, and I started working here at Deloitte a number of years back, really focusing on those entities that are pass-through entities, flow-through entities. Moreover, my focus primarily was the numerical calculation of things.
I owe it all to Professor Laura Cunningham. She was my first tax professor at NYU, which was, just taxation, U.S. federal income taxation. I can say I love tax from the beginning. It just always made sense to me. By contrast, I truly hated most of the classes at law school that I thought I would love, in particular constitutional law. This was incredibly confusing to my college friends who never would have guessed that I would become a tax lawyer. I obviously could not get enough. And so after law school, I went on and clerked at tax court in DC while completing my LLM back in New York at NYU. And so I had a very busy, first semester or first fall after law school. I then very briefly joined Piper and Marbury in Baltimore and then returned to New York as a tax associate at Debevoise. I was there for 21 years before joining Davis Polk in 2015, and I've been there ever since.
When and how did you first learn about TRAs?
So I first learned about tax receivable agreements as a young lawyer when I worked at Cravath, Swaine & Moore, and we advised on a lot of initial public offerings for both issuers as well as underwriters. And as people in the TRA world are most likely familiar with, tax receivable agreements can oftentimes come up in the context of an IPO, because when a company initially goes public, there are certain circumstances in which it makes sense to put in a tax receivable agreement, particularly if that company has a lot of existing valuable tax attributes that are difficult for capital markets and equity investors to evaluate and value, or if they anticipate that future tax attributes will be generated. And so my first encounter with a TRA was actually as a young attorney for a company that we were taking public, and it was my job at the time to kind of draft and review public disclosure documents related to what this investment was about, different characteristics of the company. And in this particular case, it was a company that was going to go public with a tax receivable agreement, which was not uncommon at the time. And so again, as a young attorney, it was up to me to first learn what a TRA was, to learn the market conventions around TRAs, and ultimately to reflect those characteristics and those descriptions in the documents that would be made available to investors.
Tax receivable agreements are largely associated with an up-C structure. So maybe kind of going all the way back, what's the first time I came across an up-C type structure? And I think the REITs sort of invented that because of the rules unique to REITs where you can't contribute property to a REIT for shares in a tax deferred transaction. They created the umbrella partnership, the up in in Up-C, we called it an UP-REIT. The first time I remember seeing that structure in a C corp, not in a REIT, was when Barnes and Noble, back in the dawn of the internet, was going to IPO their digital business, and so they formed a partnership in an Up-C structure. It did not have a tax receivable agreement, but it's the first time I can remember seeing a C corporation using that partnership. And of course, part and parcel of that structure is when the partnership interests are exchanged for corporate shares, there's a tax event and a step up. And so the first time I remember seeing people capitalize on the step up was when I read about the Blackstone IPO. And back, I think it was in 2007. And so when they incorporated the sponsor and the management company, they used an Up-C structure and a tax receivable agreement. I don't know if there was one before that. It certainly was the one at the time that garnered the most press. Probably a couple of years later before I actually was involved in working one. But it's been a bunch of time reading Blackstone and Oxif and all the ones that had used it in the sort of mid 2000s.
Yeah, so I do remember my early experience with TRAs. This was one of those another moments by judging my career and the worth of my career by what my children know. What national cinemedia is for people listening to this, and I believe it still exists, is so when you go to the movies, there's all these like advertisements before the movies, and it was a conglomerate or a joint venture between Cinemark, which at the time was owned by one of my clients, and a couple other big movie chains, and they together they had this joint venture, and they worked on putting together stuff that you would show before a movie. And I remember I would go to the movies, I'd be like, hey, to my kids, my client owns the company that invests in that. They didn't care at all. But National Cinemedia, they had a TRA. So, and I remember this was probably, I want to say like 2006 or something. And that was my first experience with it. And I remember the senior partner with whom I was working telling me, okay, go out there and look at all of, and he called them exchangeable share structures. I mean, we all call them Up-Cs now. And at the time you called them Up-Cs or exchangeable shares. And because you know a lot about how these things work, that's actually exchangeable shares is actually a fairly good description of how it works, because you can exchange your shares in an entity that's taxed as a partnership for stock of a public company, and in connection with that, you get rights under the tax receivables agreement. So he told me to go out there and pull up all of the TRA, all the exchangeable share deals that have been done, and create a chart, the different terms on all of the various aspects of a TRA. So that was my first experience with a TRA.
After DePaul, I ended up going to Northwestern Law for my LLM in tax, and that shot me to the Big Four accounting firm and then into mergers and acquisitions. So there's a little period, right, in between DePaul Law until I got my first taste, right, of TRA, and it came in the context of an Up-C transaction in 2012. So I was pulled on to a team. It was a little more cursory, but I did get to help a little bit with some modeling, high-level structuring, and that particular deal, it died. It didn't go forward. But I at least heard of what a TRA was, generally heard of what the Up-C structure was. And so it kind of put me on the map as somebody in the M&A practice that had at least one rep in that area, right? And often this is like how it works sometimes in M&A. If you get a rep in one area, a partner or a principal will know that you have that experience, and then you get pulled on right to the next one. And that's what happened. So in 2013, I was lucky enough to get drafted to be the senior manager on a bigger Up-C transaction for one of our Denver clients at KPMG. And from there, it just really it took off.
For me, it was the PLI session. You had a host on this channel, I think a few months back, Eric Sloan, who's also a leader in the Practicing Law Institute and kind of leading a lot of things from the legal perspective. He was giving a presentation on what an Up-C was. This has to be like early 2000 timeframe, and walking through that aspect of it, understanding what happened with the way that was structured, and then having the opportunity in about 2005. I was pretty much a young professional at that point, but I had the opportunity to work on a public offering for a very large named private equity client in New York. And they were instituting very comparable, Up-C-like characteristics. They had an existing TRA agreement. It was kind of novel at that time to have the structure with the TRA and the Up-C, really quantifying the monetization benefit that occurs as stakeholders of the LLC or limited partnership sell over to Pubco. And I was involved in a lot of the numerical calculations in 2005, 2004. Light bulb went off, like, hey, there's probably a marketplace out there for these clients that have this type of structure and have this type of tax receivable agreement. And slowly but surely, we've seen, and I've seen a movement towards this aspect of a client has a need from an Up-C and TRA perspective, and we as service providers have the understanding and capability and serving them, and the market has expanded since that point in time.
So while I wish I could claim that I was in the initial group that invented TRAs, I cannot. Although my guess is there are plenty of people who do. For me, it was the very public IPO of that certain investment management business that some time ago that opened my eyes to TRAs. They were, of course, as a tax lawyer, fascinating to me. They made complete sense to me, but it was actually shocking to me that people actually did it. It was great though.
How have you seen your clients' perceptions change on the topic of TRAs from your time at Cravath?
Yeah, you know what? TRAs are kind of an interesting asset class and product. What I would say about tax receivable agreements is if you look across the landscape of all public companies, and TRAs are principally a product that you find in the United States with public companies. If you look across the entire landscape, you'll actually, as you know, Andy, there's quite a few TRAs outstanding. So if you just look at the universe of public companies, there's a lot of companies out there that have tax receivable agreements. Certainly, it goes into the triple digits, right? We're talking about more than 100 companies that have tax receivable agreements. Oftentimes, though, as it relates to individual clients, and we in our business, we deal with corporate clients, management teams, boards of directors, and even owners of businesses. When the topic of a tax receivable agreement comes up, frequently it is the case that for these constituents, it's their first time learning about a tax receivable agreement, because you really wouldn't know what a TRA is until you've had an opportunity to personally to work on one with say a company that you work for. And so a lot of it is about education. And so certainly there's professionals like yourselves that deal with TRAs regularly. And I think there are players in the market that have a chance to really study TRAs, form a view on various aspects of the TRA, and then potentially have that perception change over time. But most of our clients actually are most of the people I deal with are learning about TRAs for the first time. And so part of my job is to educate them on what a TRA is, why they exist, what we're trying to accomplish when we put a TRA into place. And usually when we do that, and we'd like to think we do a pretty good job of that, our clients understand what a TRA is and then make a decision on whether it's the right fit for their particular situation. So I guess broadly speaking, I would say, it's harder to track on an individual by individual basis how views of TRAs evolve over time, because actually in this market, it's frequently the case that even for very experienced and sophisticated finance professionals or business professionals, they may only encounter a TRA once in their entire career. So I think it's a little harder to track the evolution of views in that sense. What I will say is if you take a step back and you look on a more macro view for the market, if you look at the prevalence of TRAs, for example, TRAs have really been pretty widely accepted, I would say, in the IPO market for the last 15 years or so. And so when it comes to institutional investors, I would say every year we get fewer and fewer questions about like what is a TRA, or explain to me how that works and why we have that in there. So I think there's an increasing market understanding of what tax receivable agreements are and what purpose they serve. That's one observation I would make on the macro level. And then, of course, as you know, Andy, and largely due to the work of folks like yourself, the secondary market on TRAs, where existing holders of TRAs can then sell their interest to other interested investors, that's certainly something that has become more prevalent, I would say, over the last, call it, probably 7 or 8 years.
Well, at first, with Lazard, as I was saying, I did not propose the TRA. Lazard and I had essentially worked through the Up-C structure, but it was absolutely Goldman Sachs that suggested the TRA. I remember when the company called me and said, "Oh yeah, there's this thing that Goldman had proposed." Back in the day, they were called ITR agreements, income tax receivable agreements, and morphed to be called a TRA. But in the early days after that, working with a couple of private equity firms, they got it. Explaining it to the underwriters and underwriters counsel in the first few was a little difficult because they hadn't seen it before, and just explaining to them that once you're precedent, everything rolls downhill from there. Working with companies when they started to do it, and then with their tax departments, and explaining to them that this was, because actually very recently I had someone ask me, well, what's in it for the company? And I said, well, there is this 15%, but you're not the one being benefited by this. This is going to lead to more compliance work for you. And this is for the benefit of the pre-IPO owners. It's their company. And this is a way of ensuring they get paid adequately for the value they're delivering. And so walking through that dynamic, as the major investment banks figured it out, sometimes you run into teams at the investment bank that would be hostile to it. And you just have to basically direct them to their colleagues who had worked on it before. And then as the accounting firms all began to figure it out and built up teams, it's now very much a process. And quite frankly, now pretty much anybody can do an Up-C. My fear about that is people download forms from Edgar, and I think they don't really understand them.
It has changed quite a bit. If we're kind of going back to the 2012 transaction, now we are about 12 years out from that. Early on, the sentiment was a bit hesitant as to whether or not this would work, right, from a tax and from a market perspective, right? So there was a lot of skepticism about the TRA technology and whether there might have been an impact on company valuations, right, going forward. And a lot of folks had to be convinced that the tax technical rules that underpin that TRA, that contract, right, between the public company and the partners that are selling their units to the public company, whether that worked. And it is kind of foundational, like how it works out from a tax law perspective. There's not anything that is, if you do I'll say a down the middle of the fairway, right, or non-aggressive TRA or non-aggressive structure, there isn't anything that is super controversial from a tax law perspective. So that the tax was there, and it did take a bit of modeling and explanation to some of our clients to explain why it worked out that you could give this tax asset to the public company in that exchange, right, that monetization event. But once people were on that, kind of understood that the rules, and they understood that there wasn't anything very controversial or aggressive about that planning, then you had to move on to a couple other factors, right? Economics, do the capital markets, do they approve such a contract, right? Because as we know, the public company has to file, right, with the SEC. They file things that are now publicly kind of out there, and it will specifically state that TRA liability. So there was a little bit of consternation with regard to that number and how is it going to impact the markets.
It's been interesting. Clearly has been an evolution for understanding. Not saying that everyone kind of immediately like, hey, that resonates, but after you have the time to sit down with the client and say, look, there is lost value in the marketplace, especially in a public transaction. When a client gets priced, when the underwriters price an offering and a client gets priced, Underwriters are syndicating units. They're determining how value should be derived. Value is a fairly amorphous thing from my point of view. Depends on who and what day and what willing buyer and seller you have of a given product or a given interest in the business. So from our perspective, we've seen an evolution of clients and their understanding. Once they understand that value is being lost, that underwriters and valuation folks value the business on EBITDA, free cash flow, various comparable benchmarks in the marketplace, various probabilities for things happening, and taking a weighted approach over multiple methods. But taxes are never really contemplated. Taxes are left off the stage, and no one really thinks twice about what happens in the future when certain events happen. And the tax shield that is sometimes generated when you have an exchange transaction for Pupco to get the basis step up under the tax rules, it's never valued. So what the TRA, the tax receivable agreement, effectively does is it captures that value and quantifies that. And once clients understand the fundamental economics on that aspect of it, they immediately gravitate towards it. And we've seen a growth of understanding holistically of our clients, of the product. TRAs have become very widely accepted over the past number of years. And it's been very, very challenging to really kind of meet the demand sometimes.
So I sort of divide the world, between sort of, if you will, a macro answer and a micro answer. Kind of as a macro answer, I think in the last 10 to 12 or maybe 10 to 15 years has just witnessed the broad acceptance of TRAs among pretty much everyone, including bankers, PE shops, the public and capital markets lawyers. I can tell you, if you raised it some number of years ago, there was some skepticism around it, but that's not really true today. At a more micro level, I think a person's perception of TRAs really changes the first time they see meaningful amounts of money getting paid. Kind of before that point, I think TRAs are viewed, at least by some, as just sort of the speculative thing, more something you don't want to miss out on, that's something you really think is going to give you a lot of value. But I think once a person receives a meaningful amount of cash from a TRA, either in a lump sum or just a lot of smaller payments, they tend to fall in love and never miss an opportunity to get a TRA.
What is preventing the adoption of TRAs from becoming more and more like rep and warranty? You've seen proliferation of rep and warranties in the last decade. How do we make TRAs like that?
Well, I think you're right in the sense that reps and warranties has become an insurance product that is regularly used as part of a lot of M&A agreements. I think one of the reasons why tax receivable agreements is not as prolific as something like rep and warranties is because in just about every M&A deal, there will be representations and warranties made by the seller. And so it's an inherent part of every transaction that someone might need protection along those lines. As I alluded to at the outset of this podcast, tax receivable agreements were really created and invented to address specific scenarios, which are typically either M&A or capital markets transactions where there is a differing opinion on the value of a corporate tax attribute. And tax receivable agreements are essentially a way to risk share the usage of those tax attributes appropriately and to be able to allow transactions to occur without having the uncertainty of that value of the tax asset be an obstacle towards completing the transaction. And not every transaction has that type of fact pattern where you have a delta in the valuation of a specific tax asset. So I think that's one reason why you see TRAs being less common than something such as reps and warranties insurance, which you see frequently in M&A deals. That's certainly a big driving factor. I think what we can say about tax receivable agreements is it can be a very useful product and it can be a very useful value bridge in the right situations. So certainly in our world as investment bankers, we want to make sure our clients understand all of the available solutions to them. And so it's our job when the right fact pattern exists to educate our clients and let them know that something like tax receivable agreements are available to bridge value gaps.
I think TRAs, they're a little different than the rep and warranty insurance. So again, a bit more speculation on my part. I'm not, in that area, not a valuation expert, et cetera. But from my perspective, there's general hesitancy from buyers and sellers to enter into an arrangement that might last 20 plus years, right? The TRA is often a contract to essentially get paid for the tax asset that you deliver to a buyer. And a lot of times that tax asset, that attribute, it amortizes off over 15 plus years. And so it's a long time, to have that agreement with a buyer and a seller. So if you're looking at traditional private equity transactions, so PE, either buyer or seller, but let's say seller in this case, sells their company to another, a buyer, and they want to get paid for that step up, right? Let's say it's in either a 338 H10, so it's a corporate setting, but you get a step up, or maybe you are selling a partnership interest and you're delivering a step up either to the assets or to the partnership interest, which then gets allocated to the assets under certain tax provisions. In those cases, what we typically would see is that the buyer and seller would model those benefits into the free cash flow model, their financial model, look at what the discount rate is, figure out, how you might bake that into the equity value, the equity number, and you kind of go from there, right? That's your default. As far as contracts that span past the closing, we do see earnouts, right? So earnouts are relatively, relatively common in transactions where a buyer is willing to pay incremental proceeds on the basis of some economic performance down the road. In other words, let's say they used EBITDA as that measuring point. If you get to EBITDA times X, perhaps the buyer is going to pay the seller another 5%. If it gets EBITDA times Y in year 2 or 3, they might pay, purchase price plus 10%. But those are usually just a couple of years, right? A couple of years out is what I've seen. And they're not typically dependent upon tax attributes. They're usually dependent upon, I'll say, overall cash flow and financial statement economic performance. And so when you move into the land of TRAs, where you are talking about a tax attribute that is contingent upon the company making taxable income, and then also the span, right? It could just last decades. There's that hesitancy there. And what I would say, though, is if and when, that secondary market for a TRA grows and there are more avenues for what would now be the seller, right? The seller of the entity that gets that TRA asset. If they have an avenue to monetize that, I could see TRAs being much more ubiquitous, right? Possibly more in line with rep and warranty to the extent that the seller is delivering that tax asset. The reason I say that is because it gives a little bit of protection to the buyer, right? So someone that's paying that TRA payment, well, they don't have to pay it unless they get the benefit of the tax attribute.
I'd say there is, at the moment, we haven't seen a whole lot of IPO activity this year. You're probably gonna nod at that. And there are a number of organizations that are organized as LLCs and limited partnerships in this country. And as the IPO market kind of ticks up, those organizations will have the opportunity to go public. And sometimes it's debatable from a business standpoint, do we want to retain the current structure of the LLC or the limited partnership? Do we want to just go a pure corporate route and public offering as a typical C corporation? And I think the few constraints would be making sure the market understands and people understand the benefits of the Up-C and the TRA, making sure folks really kind of are able to quantify the numerical aspects for their organization prior to making those decisions. And I'd say holistically, the number of businesses that are currently operating as an LLC and LP, at least from an Up-C standpoint, that would restrict the amount of TRAs and that context. But those are the factors, at least from a public marketing view, that is, that I would say would be restriction factors on the acceptability of the Up-C and the TRA in that regard.
So I think for Up-C structures, TRAs are, frankly, have become ubiquitous, at least as much as rep and warranty policies. Indeed, I think the TRA is the primary reason a lot of people do an Up-C transaction. I think TRAs that are less common when the business that's being taken public is already housed in a C corporation. And I think there are a few reasons for that. I think first, many corporations being taken public don't actually have material tax assets. That's a change. Years ago, before Congress changed 163J to make the use of interest much more difficult, a lot of companies being taken public had very large NOLs that have been generated by very large interest deductions. You see that a lot less today. But when you saw that, you saw people taking TRAs to monetize the NOL. There are still companies like that, but I just think it's a lot less prevalent than it used to be. There are cases when you see a C Corp with material tax basis in its assets. Normally, if it's done a big asset deal or an asset deal was done as a partnership that you collapsed into a C Corp, you do see TRAs in that case. But I think that fact pattern is simply less common than having an Up-C. I think in the private sale context, we're sort of outside of an IPO, where I think rep and warranty policies are kind of most prevalent, I think the market for paying for tax benefits is really very different than what you see under a TRA, and it's much more bespoke. Indeed, I think one of the great benefits of rep and warranty policies is that allows a buyer and seller to separate on the closing date and not deal with each other. I think that's the great thing about that policy. If you can imagine overlaying a TRA on that, it's sort of the opposite, because what it does is it entangles them sort of during the life of the agreement, which in the public TRA case is a very long time. And in a context where actually they're trying to separate, not come together. It's the end, not the beginning. So you see it. You sometimes see people praying for tax benefits, but normally it's either in the headline price or paid over a much shorter period of time.
Keep riding with us as we blaze the TRA trail by subscribing in your preferred podcast app. Learn more and get in touch at plxcap.com. That's plxcap.com. Information presented is for informational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any securities. Parallaxes Capital Management LLC's podcast and its associated links offer news, commentary, and generalized research, not personalized investment advice. Nothing on this podcast should be interpreted to state or imply that past performance is an indication of future performance. All investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to consult with a tax professional before implementing any investment strategy. Investment advisory services offered through Parallaxes Capital Management LLC are registered investment advisor with the U.S. Securities and Exchange Commission. Registration does not imply a certain level of skill or training. Past performance is not indicative of future results.